And starting off with PacWest shares, they've been tumbling since the California lender said it's weighing strategic options for its business, including a possible sale or fundraising round. Now, this comes just after Fed Chair Jerome Powell made those assurances in that press conference that the banking sector is making positive strides.
I think that the resolution and sale of First Republic kind of draws a line under that period of, is an important step toward drawing a line under that period of severe stress.
Joining us now to discuss is David Chiaverini, Wedbush Securities Managing Director of Equity and Research. Good to have you on the show here. So trying to sort of gauge that sort of optimism, at least about financial stability from the Fed versus what we're still continuing to see here with PacWest. What are you making of this?
Yeah, so we're in an environment where investors are on edge. And when a company comes out and says that they're exploring strategic options, investors tend to think that that means things are not going well. Now, they added some clarification based on the story that was broke by a media outlet with a press release last night saying that deposits have been stable this week post First Republic, going into receivership and sale to JP Morgan. But looking at the first quarter numbers, PacWest was on the weaker end in terms of deposit outflows. They had deposits decline 17% in the first quarter. That was at the upper end of the peer group. And they also screened poorly on a tangible book value basis when taking into account the fair value marks. And those were the issues that basically took down Silicon Valley Bank and took down First Republic. And PacWest on that basis is only has $1 of tangible book value on a fair value basis as of 12/31. Now, interest rates have come down since then, so the 331 mark could be incrementally better. The 10Q hasn't come out yet, so we don't know what that number is, but that doesn't screen well for them. But what they have going for them is that since 12/31, their insured deposit level was 45%. They've improved that to 75%. So that should mitigate deposit outflows in this type of environment. Now, given that the stock is down significantly, the stock price action has become a factor in the way depositors think about their bank. So if they see their bank stocks is down significantly, that might spook them and lead to deposit outflows. But they're doing their best to try and calm their deposit base, and we'll see how that progresses.
David, what are some of the most important steps that regional banks can take right now to mitigate the risk of failure, if there is still a step that they can take?
Yeah, the main thing that some banks have been utilizing is this service called ICS, is Insured Cash Sweep. So it's a network of banks that come together and basically swap deposits with one another to increase the insured deposit level. And they can keep the deposit costs at the same rate. So basically, if a bank brings in an account that's above the $250K threshold, say it's $1 million at a deposit cost of, say, 3%, another bank with a similar deposit level, they can swap out deposits and open up additional accounts with each other to kind of circumvent that $250K deposit insurance cap. So that's what Western Alliance and PacWest and others are utilizing to increase their insured deposit base. And I'm expecting this service to essentially become table stakes for the industry because it's an easy way to increase the insured deposit level. Outside of that, the banks really have to just continue to execute the way they always do. Bringing up their capital levels is certainly going to become a focus of banks over the next few quarters. And PacWest is pretty much top of mind trying to get their capital ratios up. For instance, they were at 9.2% for their common equity tier 1 ratio at 331. They're looking to bring that up north of 10%, and they're doing that by selling some assets.
And even within the banks themselves, you also have this issue of some of this money going towards these money market funds as people are still chasing high yields. How does that play into the picture as well?
Yeah, that is proving to be potentially more fierce competition than the banks themselves, because the rates that you're getting on money market funds are approaching 5%, right in line with the Fed funds rate. And that is a very high level when you compare it to what depositors have been getting within the banking industry over the past several years, for that matter. So they need to try and compete with those money market funds by bringing up their own deposit rates. And that's putting pressure on their net interest margin. So it's not very good fundamentally for the banks for that to be happening, because as their net interest margins come down, the net interest income comes down. So it pressures their EPS.
David, in terms of the kind of chronological order that this is all taking place in, it's hard not to think back to the assets that JP Morgan was able to pick up, a large bank that basically got a call to step in after the FDIC receivership of First Republic Bank assets. And so with that in mind, did the FDIC pulling in other big banks and essentially ushering them into the deal table, did that trigger some of this broader activity and the sell-off in regional banks that we've seen this week?
You know, I don't think that hurt the cause. In fact, there was an initial sort of euphoric action in the price of the stocks, the bank stocks, after that $30 billion infusion into First Republic. But the issue seems to be, at least for the ones that failed, seems to be on the capital side, not necessarily on the liability side. And when you infuse 30 billion of deposits, it essentially increases the liabilities. Now it helps with the funding, but what First Republic needed was equity capital, not necessarily additional, because what it turned out to be essentially the 30 billion of deposits was really 30 billion of additional borrowings, right? Because they did ultimately eventually have to pay that back. So I think that if the big banks were to, rally behind other banks, it wouldn't be a negative. But now at this point, the way the bank investors are reacting to any intervention from other big banks, it could be viewed negatively, because the reason why they had to infuse $30 billion into First Republic was because it was teetering. So it's a very, you're kind of walking on eggshells if you're a bank management team, where you don't necessarily want to come out and, take some help from other banks, because it may signal that there's problems, under the hood with your own bank. So they have to tread carefully in this type of environment.
So then if you are trying to invest in banks right now, and you're already seeing that JP Morgan has already taken on First Republic, when you think of other big banks then who might have to come to the rescue, as they've already passed that 10% threshold, where does that leave bank investors, and how are they viewing this landscape?
Yeah, so the way we're recommending to investors is focus on the defensive names and focus on the ones that screen better on a tangible book value and on a fair value basis. So we like New York Community Bank, we like M&T Bank, we like Fifth Third, Regions Financial. These are all banks that I'm kind of viewing them as down the fairway in terms of their stability of deposit flows, stability of their capital base, and they're types of banks that I think investors won't be spooked about keeping their deposits in there. So there is a way to invest in this type of environment, especially for those banks that are not teetering. You're getting a bit of a discount in this type of environment. Now, with that said, we're being very selective with the names that we're recommending, because we think from an industry perspective, this pressure on net interest margins and funding costs is going to continue to pressure the group for the next 3 to 4 quarters, and then credit quality is going to start to rear its head on the commercial real estate front over the next 12 to 18 months. So we are very cautious on the group overall, but there is a selective way to participate if you're a bank investor.
All right, a lot of these regional banks scrambling to make par right now. David Chiaverini, Wedbush Securities Managing Director, Equity Research. David, great to have you here with us this morning. Appreciate it.